Okay, so let's start. We want to start a new topic now. And our topic is called group accounts. Now, this is not a new topic to you at this level because you must have learned it. You must have learned it at the intermediate level, that is at the financial reporting. So for the beginning, I'll just be reminding you some of the key issues you did at the intermediate level when you are doing the financial reporting. You did the topic group accounts. So when it comes to consolidation of the balance sheet, don't write fast, but when it comes to group balance sheet, if you are required to prepare group balance sheet, what are some of the areas that you are required to remember? What are some of the areas that you are required to remember? And the following are the areas I need you to remember on how you are dealing with them. Of course, I'll remind you, but as far as group balance sheet consolidation is concerned, and especially for a subsidiary, you are expected to remember the following. 1. How are you accounting for what we call intercompany debt? How are you accounting for intercompany debt? That's one thing I need you to remember. The second thing you need to remember concerning group balance sheet is how are you dealing with what we call an unrealized profit? How are you dealing with what we call an unrealized profit? That's the second thing. The third thing you need to remember is how are you dealing with what we call debentures in subsidiary. You remember that over and above you buying ordinary shares, you as a holding company, over and above you buying ordinary shares in a subsidiary company, you could also invest. You could also invest by buying their debentures. When a subsidiary wants to raise more capital or more finances, they could issue debentures. And that does not stop you as a holding company by buying part of their debentures. So how are you dealing with the debentures in subsidiary? The other thing I need you to remember is how are you dealing with what you used to call fair value adjustment. Fair value adjustment. Some books used to call it revaluation adjustment. How are you dealing with the revaluation adjustment? That's another area you need to remember. Another key area you need to remember is how are you dealing with what we call intercompany sale of fixed assets. Intercompany sale of fixed assets. That means when you as a holding company, you sell a fixed asset to a subsidiary company, or a subsidiary company sells to you a fixed assets. How are you dealing with that as far as group balance sheet is concerned when you are consolidating the balance sheet? So these are some of the areas you need to remember when it comes to group balance sheet or consolidation of the financial statement called statement of financial position. Okay, so let me remind you how you are dealing with each of them. I want to start with the first one, and the first one is what we call intercompany debt. Intercompany debt. One time, you as a holding company, you sold goods to your subsidiary company on credit. One time, you as a holding company, you sold goods on credit to your subsidiary company. Let us assume that you sold to them goods worth 20,000 during the year. You sold to them goods worth 20,000 during the year. But by the end of the year, that subsidiary company has not paid you for those goods. So when you sold to the subsidiary company, you debited the subsidiary as a debtor, just like any other customer. You debited the subsidiary company as a debtor and you credited sales. That's what you did you as a holding company, that's what you did. So if by the end of the year, the subsidiary company has not paid you, then it means that in the datas of that subsidiary, in your datas, you as a holding company, among your datas, you have this 20,000 shillings, which is due from S Limited. You have 20,000 which is due from S Limited. On their own, listen again, S on their own, they purchased the goods from you. They purchased the goods from you. They bought them on credit. So just like any other supplier they are buying from, they debited purchases. Who? The subsidiary. They debited purchases and credited creditors. That's what they did. So again, by the end of the year, that subsidiary company has not paid you. So in the books of the subsidiary company, among the creditors there, in their books, they are saying they owe you 20,000. So in that case, the subsidiary in their books have a creditor, which is H, and that is an amount due to 20,000 due to H Limited. Good. So you in your books as a holding company on your own, you are demanding 20,000 from your subsidiary. On the other hand, the subsidiary also on their own, they are saying they owe you 20,000. That's okay. But when we are preparing group accounts, you should remember, when you are preparing group accounts, you should remember that we normally consider these two companies now as one company. When you are preparing group accounts, we look at the holding company and the subsidiary company, we look at them as one company. From the group's point of view, they are one company. But on their own, yes, you are demanding 20,000 from S, and S on your own, you are saying you owe H Limited 20,000. But as far as the group accounts are concerned, we look at these two companies as one. And if we look at the two companies as one, and we want to prepare the accounts for the group, again, the point is, can you demand from yourself? Can you owe yourself? The answer is no. So when it comes to group accounts, then we normally say, listen, we normally say any intercompany debt between group members, that intercompany debt should be eliminated. That's the key word. Any intercompany debt should be eliminated. Any intercompany debt between group members should be eliminated. When you are preparing the group balance sheet, that intercompany debt should be cancelled. So the question is, how do you cancel it? That's the question we want to remind ourselves. Okay? Now, when you are preparing this, or you are doing this in group accounts, in your financial reporting, you remember you used to open an account called, group datas. Don't write. You used to open an account called group datas. In your consolidation workings, you also used to open another account called group creditors. Group creditors. You remember, you used to go to the balance sheet of the holding company, pick their data from their balance sheet, whatever the question will give it to you. Then you had to go to the balance sheet of the subsidiary, again, pick their data, whatever the question will give it to you, whatever it is. Then you had to do the same for the creditors. Go to the balance sheet of the holding company, pick their creditors, whatever it is. Go to the balance sheet of the subsidiary company, pick their creditors, whatever it is. Then, now the question told you, included in the datas of H Limited is 20,000 shillings due from S Limited. And also the question tells you, included in the creditors of S Limited is 20,000 shillings due to H Limited. Now that we are preparing group accounts, can you owe yourself? We have said no. This intercompany debt should be cancelled or should be eliminated. So how do you cancel it? It's obvious. To cancel 20,000 out of the debtors of H, you have to credit the debtors account. So you remember, you had to credit the account called group debtors with that 20. To cancel the 20 from the debit, you had to credit the 20. At the same time, when you had to prepare this account called group creditors, from the creditors of S, there you had to cancel another 20 because you can't owe yourself. So to cancel 20 from the creditors, you had to debit. In other words, we are saying, if you remember, when there was an intercompany debt between group members, to eliminate that intercompany debt, listen, you had to do what we call a contra entry. You had to do a contra entry between the group debtors and group creditors. In other words, you had to debit group creditors, and you had to credit group debtors. That's how you used to eliminate any intercompany debt between group members. That intercompany debt should be eliminated by debiting group creditors, and you had to credit group debtors to eliminate it. Okay, so that's a reminder. I've reminded you on how you used to deal with intercompany debt. Good. My other point is, there are questions that used to tell you, included in the debtors of H Limited is 20,000 shillings due from S Limited. Then the question could have told you, included in the creditors of S Limited is 15,000 due to H Limited. So by the end of the year, me as a holding company, I'm demanding 20,000 from my subsidiary. And you at the end of the year, you as a subsidiary company, you are saying you owe me only 15,000. There is a difference of 5,000 shillings. What could it be? If me by the end of the year, I'm demanding 20,000 from you, and you as a subsidiary company, you are saying you owe me 15,000. There's a difference between the two debts by 5,000. What could it represent? Somebody remind me by chatting. Somebody remind me by chatting. What were you taking that 5,000 to be? I've told you we are reviewing what you used to do in financial reporting. Before we do questions, these concepts are also going to be applied at this level. So remind me by chatting, what were you taking that 5,000 to be? By the end of the year, I'm demanding 20,000 from my subsidiary, but at the same end of the year, the subsidiary says they owe me only 15,000. There's a difference of 5,000 between the two intercompany debts. What was it representing? Yes, I want you to chat and tell me what you think it represented. That 5,000. What do you think it was representing? Yes. Chat and give me, it's a reminder. These are things you did at the financial reporting level. So this 5,000, what do you think it represents? Or what were you taking it to be? What were you taking it to be? By the end of the year, me, I'm demanding. No, it's not an unrealized profit. I sold goods to you. Listen, I sold goods to you. And by the end of the year, I still am demanding 20,000 from you. Meaning, I must have sold goods to you for 20,000 during the year. Come the end of the year, somewhere, you as a subsidiary company are saying, you don't owe me now 20, you owe me only 15,000. So this difference of 5,000, what could it be? Listen, that 5,000 could be because of two reasons. So far, nobody has given me any right answer. For those who have tried, they have not given me any answer. But I'm saying this 5,000 could be because of two things. So I want at least to be reminded, one, what could that 5,000 represent? That's an attempt, Kevin. That's an attempt. That's of course an attempt. I will explain it. Somebody else? That's an attempt. That's correct. That's correct. That's an attempt. Somebody else? There was one of the most common reasons. It seems like people have forgotten this topic. Seems like people have forgotten. This 5,000, what could it be? Other than what Kevin has given, which I will expound on. Jeremiah has specified it in details. Jeremiah has specified it in details. That's one. That could be because of what we call goods in transit. I will explain it. Goods in transit. Apart from goods in transit, what else were you taking that 5,000 to be? So one possible reason could be because of the goods that are still in transit. Listen, what Jeremiah is saying is this, that yes, I sold goods to you, me as a holding company, for 20,000. I debited debtors, I credited sales. You as a subsidiary company, you bought goods from me worth 20. That's true. But come during the year, listen, you as a subsidiary company, for whatever reason, you found that maybe these goods were more than you needed. Or maybe some are damaged. And you decided, listen, and you decided to return some of them. To who? To the holding company. So when you returned them, the moment you returned those goods, you as a subsidiary company, you reduced what you owe to the holding company. You must have debited creditors by 5,000 with the goods that you returned, because you don't need them. So you had to reduce what you owe to the holding company. So you must have debited creditors. But it happened that come the end of the year, the holding company may not have received the goods. So if they have not received the goods, then they are still demanding from you 20,000. Kumbe, the subsidiary on their own, they have returned goods worth 5,000. And in their books, they have already reduced what they owe you. So they don't owe you 20 as they are per the original amount. They now owe you 15 because they have returned goods to you. And the moment they returned goods to you, they had to reduce what they owe you. Okay? But by the end of the year, 31st December, you as a holding company, you have not received the goods. So the goods are still in transit. Okay? So that's one possible reason, because of the goods being in transit. Another possible reason, now somebody has given us, Patrick has given us, another possible reason could be because of the cash in transit. Could be because of the cash in transit. Again, this subsidiary company could have sent to you a check of 5,000 by the end of the year. The moment they sent the check to you, they debited creditors to reduce the liability. They debited creditors. Of course, they must have credited bank. So they reduced what they owe you. Fine. But you, by the end of the year, 31st December, you had not received the check. So you, as a holding company, you are still demanding 20,000 from your subsidiary. Yet, the subsidiary company has already paid you 5,000. It's only that you, as a holding company, you have not received that check. So we are saying, if you have not received the money or the check, whatever it is, then that is what we call cash that is still in transit. Good. So what do you do? That's what we want to talk about now. It's just a reminder. What do you do when the amount of the intercompany debts are not the same? We are now concluding by saying, when the amount of the intercompany debts are not the same, the difference should be considered to be either cash in transit or goods in transit. So before you eliminate, listen, before you eliminate the intercompany debt, now first, as a holding company, listen, as a holding company, first account for that 5,000. If the difference is because of the cash in transit, listen, then you are demanding 20,000. That's true. But this time, the subsidiary company doesn't owe you 20,000. They owe you only 15,000 here. So now that you are demanding 20, and the subsidiary company says they owe you only 15, first account for the 5. If it is because of the cash that is still in transit, then it means the subsidiary has already paid you. So first, as a holding company, account for it. How? By debiting the account called cash in transit. You, as a holding company, you debit the account called cash in transit by 5,000, and then you credit group debtors by 5,000. That way, you have accounted for the cash in transit. Once you account for the cash in transit, now it is obvious you are no longer demanding 20,000. You are no longer demanding 20,000 from your subsidiary company. Now you are demanding 15, which is the same amount that the subsidiary company says they owe you as a holding company. Now again, once you account for the cash in transit, you can now see the amount of the intercompany debt again becomes the same. Now I'm demanding not 20, now I'm demanding 15. You, as a subsidiary, you are saying you owe me 15. From the gross point of view, can you owe yourself? The answer is no. So again, that 15 should be eliminated. How? By doing a contra entry. You debit group creditors by that 15 and you credit group debtors by that 15. That's how you account for the cash in transit. If the difference was because of the goods that are still in transit, same. You, as a holding company, you have not yet accounted for the goods that are being returned to you. So first account for those goods. Okay? How? Again, you will debit goods in transit account by 5,000 and you will credit group debtors with the goods that are still in transit. Because the subsidiary has already returned goods to you. They accounted for that in their books by reducing what they owe you. But you, as a holding company, you have not reduced what the subsidiary owes you. So first account for it by debiting goods in transit and you credit debtors. Once you account for the goods in transit, you are again no longer demanding 20,000 from your subsidiary. No, you are demanding 15,000. That 15,000, now you eliminate it. Again, by doing a contra, you debit group creditors, that is what you do, and you credit group creditors. Good. Now, for examination purposes, some questions don't tell you what that 5,000 represents. Whether it represents the cash in transit or goods in transit, some questions don't tell you. The point is, when the question is silent, then you take that 5,000 to be cash in transit. Where the question is silent, we always assume that the 5,000 represents cash in transit. Good. I think I've reminded you one of the key issues that you need to remember concerning group balance sheet, and that's what we are calling intercompany debt. Good. So let's put down a summary note. We are just putting down a summary note concerning it, because already you had this information. So we are just putting down a summary note. So put down the topic, group accounts, and then below that, put down another subtopic, group balance sheet. Group balance sheet. Group balance sheet. Group balance sheet. Then below that, another small subtopic, intercompany debt. Intercompany debt. Intercompany debt. Intercompany debt. Then you say this. Then say this. Once you are through with that, you say this. Any intercompany debt between group members, should be eliminated. Any intercompany debt between group members should be eliminated. The key word there is eliminated. Maybe you can even underline it. Any intercompany debt between group members should be eliminated. Should be eliminated. Another paragraph. If the amount of the intercompany debt is the same, if the amount of the intercompany debt is the same, if the amount of the intercompany debt is the same, in debtors and creditors, if the amount of the intercompany debt is the same in debtors and creditors, if the amount of the intercompany debt is the same in debtors and creditors, then it should be eliminated as follows. It should be eliminated as follows. It should be eliminated as follows. Let's put down the double entry. Debit, group creditors, and you credit group debtors. Debit group creditors and you credit group debtors. So that way you have eliminated the 20 and the 20 I started with. Okay, 20 and the 20 I started with. That's how you eliminate it. You debit group creditors and you credit group debtors. Good. Another paragraph. If the amount of the intercompany debt is not the same, both in debtors and creditors, if the amount of the intercompany debt is not the same in debtors and creditors, if the amount of the intercompany debt is not the same in debtors and creditors, the difference should be considered to be either cash in transit or goods in transit. Difference should be considered to be either cash in transit or goods in transit. Stop, then you continue. With the cash in transit or goods in transit, with the cash in transit or goods in transit, the following entry should be made. With the cash in transit or goods in transit, the following entry should be made. Debit, cash in transit, stroke, goods in transit, debit cash in transit, stroke, goods in transit, credit group debtors. Debit cash in transit, stroke, goods in transit, credit group debtors. Then you say this, another paragraph. After making the above adjustment, comma, the amount of the intercompany debt. After making the above adjustment, the amount of the intercompany debt. After making the above adjustment, the amount of the intercompany debt. The amount of the intercompany debt will be opposite and equal to each other. After making the above adjustment, the amount of the intercompany debt will be opposite and equal to each other and should therefore be eliminated. Amount of the intercompany debt will be opposite and equal to each other and should therefore be eliminated. And should therefore be eliminated. Another paragraph. The amount of the cash in transit, or goods in transit, the amount of the cash in transit or goods in transit, the amount of the cash in transit or goods in transit should be considered as an asset of the group. Should be considered as an asset of the group in the consolidated balance sheet. The cash in transit or goods in transit should be considered as an asset of the group in the consolidated balance sheet. Good. So I think I've reminded you everything you need to remember concerning that first adjustment, which we call intercompany debt. It's normally common in any balance sheet question. It's normally a common item in any balance sheet question whenever you are given a question of group balance sheet. Normally, intercompany debt will be one of the adjustments. Okay? Let's go to the next one. We again want to remind ourselves. The second one we want to remind ourselves is how are you dealing with what we call an unrealized profit on closing stock. Unrealized profit on closing stock. How are you dealing with unrealized profit on closing stock? That's what I want to remind you, because it's another area you must have done. Let me remind you first. I sold goods, me as H Limited, I sold goods to my subsidiary company goods that costed me 100,000, I sold them to my subsidiary company for 120,000. Come the end of the year, that subsidiary company has not sold all of these goods. I sold goods to my subsidiary company, goods that costed me 100,000, sold them to my subsidiary company for 120,000. By the end of the year, this subsidiary company has not sold any of their goods. On my own, when I sold the goods, I made a profit of 20,000. That's okay, because I sold them for 120. Costed me 100. On your own, you as a subsidiary company, in your closing stock, you will have stock amounting to 120,000 in your stock. Now we are looking at these two companies again as one. I sold goods to you. I made a profit of 20,000, me as a holding. US, you have not sold these goods. So in your stock, you are still having stock worth 120,000 from the group. Now, the question is, we are now looking at the two companies as one. Can you sell to yourself at a profit? Can you sell to yourself at a profit? The answer is no. We are one company now. When I sold them on my own to you, fine, I record the profit. US, you bought the goods at 120, fine. But now that we are one company, there is no way you can sell to yourself at a profit. No. So we are now concluding by saying again, this 20,000 profit I am claiming to have made, me H, that 20,000 is what we are calling an unrealized profit of how much? 20,000. That 20,000 must also be eliminated. That's again the key issue when it comes to an unrealized profit on closing stock. You can't sell to yourself at a profit. That profit should be eliminated. So the question is, how do you cancel or eliminate that 20,000? That's what we want to answer now. How do you eliminate or cancel that 20,000? Okay, good. When I sold goods to you, me H, I recognized a profit of 20,000. So my profit as a holding company is overcasted. From the group's point of view, my profit is overcasted. On my own, my profit is okay. But now when we are looking at the two companies as one now, my profit is overcasted. The stock of the subsidiary company, they have a stock of 120 in their balance sheet. Their stock also should be in the books of the group. The stock of S should be in the books of the group, not at 120. They should be in the books of the group at how much they costed the group. And they costed the group an amount of 100,000. But US, you have shown them at 120 in your books, which is okay as far as your books are concerned. But as far as the group is concerned, they should be in the books of the group at 100,000. So you as a subsidiary company, your stock, as far as the group is concerned, your stock is overcasted by 20,000. So we need to reduce or to eliminate that 20,000, listen, by reducing the profit of the selling company. Whoever sold reduced their profit by 20,000. Whoever bought the goods reduced their stock by 20,000. That's how we normally cancel that 20,000. How? By debiting the P&L account of the selling company. Whoever the selling company is, you debit P&L account of the selling company and you credit the stock of the purchasing company. You credit stock of the purchasing company. Whoever the company that bought the goods, you credit. You reduce their stock as far as the group is concerned. Okay? You find sometimes in questions, you will see, or in some workings, you will see what we call group stock. Some books will open an account called group stocks. They will go to the balance sheet of H when they are doing the consolidation workings, pick the stock of H, go to the balance sheet of S, pick the stock of S. It is this stock of S that we are saying is wrong. The stock of S there includes 120 instead of 100 as far as the group is concerned. So their stock is overcasted by 20,000. So you can come and credit group stocks by 20,000. That's what we are trying to say. So you can reduce the profit of the selling company and you come and credit what we can call group stocks by 20,000. Or you just credit stock of the purchasing company. In other words, just reduce the stock of the purchasing company. Good. So that's how you eliminated. That's how you are eliminating that amount or the unrealized profit. Before we leave it again, you may be told, I sold goods to you which costed me 100. I sold them to you for 120. Then the question told you, this subsidiary company by the end of the year has not sold half of the goods. Half of the goods are still remaining. Half of the goods are still remaining in the subsidiary. So when I sold goods to you for 120, listen, I made a profit of 20. You, the subsidiary company, you have not sold goods worth half of the goods you have not sold. Half of them have left you. So half of the goods have left the group. That means the subsidiary has already sold them. So now that I sold goods to you and I made a profit of 20 on my own, and you, S, you have not sold half of the goods, then automatically it means that as far as the group is concerned, we have not earned half of this 20,000. So a half of 20,000 is what we are now going to call the unrealized profit, because the half of the goods are the ones remaining, which in our case here will be 60. The goods that are remaining in S are half. So if S bought goods for 120 and they have not sold half, they are remaining with goods amounting to how much? 60 in their books. These goods that you sold to S at 60 costed you how much? The original ones costed you 100. Half of them have not been sold. Those half that have not been sold must have costed you how much? 50. So when you sold the goods that costed you 50 and you sold them to your subsidiary for 60, then 10 is what we are calling the unrealized profit, which is the same as just getting whatever profit that was made initially when we sold goods costing 100 and we sold them to the subsidiary for 120, and the question tells you half of the goods have not been sold, then first you compute the profit made by the selling company, whoever sold. Once you get the profit, which in our original case it was how much? 20,000. Then find out what proportion of the goods have not yet been sold. What proportion of the goods? If the question tells you half of the goods have not been sold, then take half of that profit. Half of the 20 is what you consider to be the unrealized profit. If the question tells you a quarter of the goods have not been sold, then it is a quarter of 20,000 that you consider to be the unrealized profit. Okay, good. So I think I've now talked about or reminded you how to deal with what we call the unrealized profit. Listen, it does not matter who is selling the goods to who, whether it is the holding selling to the subsidiary or it is the subsidiary selling to the holding. It doesn't matter. Whoever sold the goods, their profit is overcasted. Whoever purchased the goods, their stock is overcasted. So we need to eliminate whatever amount we get as the unrealized profit. Okay? To eliminate it, I've told you, you debit P&L account of the selling company and you credit the stock of the purchasing company, whoever it is. Then I've talked about whatever proportion of the goods have not been sold. Sometimes questions have that issue. Okay? The other issue is, I've given you a straightforward illustration. But some questions give you things something like this. Let me just give you a question. Suppose the question told you, during the year, H Limited sold goods costing shillings 300,000 to S Limited at a profit margin of 25%. Then unaambiwa half of the goods have not yet been sold. Half of the goods have not yet been sold by S Limited. So how much would be the unrealized profit? How much would be the unrealized profit here? Somebody take a minute and calculate it for me. How much would you consider to be the unrealized profit in this illustration? Somebody take a minute and calculate it for me. If the question told you, during the year, H Limited sold goods costing 300,000 to S Limited at a profit margin of 25%. Half of the goods have not been sold by S Limited. How much is the unrealized profit that we shall eliminate? Take a minute, calculate it, and give it to me just to see whether you can remember. I've told you these are not new things. These are things you must have done. These are things you must have done in your financial reporting. Somebody's getting 37,500. Somebody's getting 37,500. Another person is getting 37,500. Two people are giving me 37,500. Another one, 37,500. Read the statement correctly. I'm not saying you are wrong, but I just want you to get the statement correctly. Okay? Three people have given me 37,500. The fourth one the same. Fourth one the same. The fourth one the same. I've said, for those who have not calculated, read the statement correctly. Read the statement correctly. Another person is giving me 30. Another one is giving me 19. Read the statement correctly. Read that statement correctly. Good. Now, listen. First, listen carefully. First, determine the profit that was made by H. Once you get it, half of that profit is what we are saying has not yet been earned. Are you there? First, get the profit made by H. Once you get it, then half of that is what we shall call an unrealized profit. I want to throw the challenge again. Listen. So far, listen carefully. So far, nobody, listen, I'm throwing the challenge again. So far, for those who have given me, nobody has got the right answer. I'm throwing the challenge again to you. I thought you could remember what you did in financial reporting, because this is also common there. I've thrown the challenge to you again. I've thrown to you as the challenge again. Calculate for me the unrealized. So far, I've said, whoever has given me the answers are wrong. Think again and recalculate now once you think. These were common issues that examiners used to hide. First, calculate the profit made by H. Okay. Anybody who can attempt? No. Tobias, no. Oh my. Yeah. No. Listen now. First, listen. I want to know, what profit did H make when they sold the goods? The question is this: can I take 25% on 300 to get the profit H made? Can I take 25% of 500, of 300? The answer is no. Listen, the question is not saying H sold goods for 300. Get the point? The question is not saying H sold goods for 400. No. They are saying H sold goods costing 300 to S Limited. The question is not saying H sold goods to S for 300. No. They are saying H sold goods costing 300 at a profit margin of 25%. So there is no way you can take 25% of 300 to determine the profit made by H. Why? Why is it not possible to take 25% of 300? Why? Because 300 is the cost. 25% is the profit margin. Profit margin normally is determined Otieno, again, no. Listen, profit margin is derived by taking GP. You know how to get profit margin. You know the ratio. It is normally given by GP divided by what? Sales times 100. That's how we normally get profit margin. Now, so this profit margin of 25%, you cannot say 25% is equals to GP divided by sales. You don't know the GP, you don't know the sales. So you already have two unknowns. You already have two unknowns. So it's not possible to take 25% of 300. Why? Because margin does not go with the cost. So for this case, the examiner wanted you to look for something that goes with what you have. You have the cost. What is it that goes with the cost? What goes with the cost is what we call the markup. If the question had told me we sold goods costing 300 at a markup of 25%, most of you could be right in the answers you have given me. Most of you would have been right. If the question told us goods costing 300 were sold at a markup of 25%, majority of those who have given me the answers would have been right. But now we are not given markup, we are given margin. And margin does not go with the cost of sales. Margin goes with the sales, not cost. So you needed something that goes with the cost. And what is it that goes with the cost? It's the markup. Because markup, you know the formula, it's GP divided by cost of sales. That's how we get the markup. It is GP divided by cost of sales. Now listen. So you needed to know, for this case, you needed to know what's the relationship between markup, between margin and markup. What's the relationship? How can I convert my margin to markup? Our margin is 25%, which in simple fraction, it's a quarter. But I know margin goes with the selling price. I don't know the selling price. What I know is the cost. So what I need is markup, not margin. So tell me now, if the markup is given to you, margin, sorry, is given to you as a quarter, a business has their margin being a quarter. What must be their markup? Their markup must be 1 over what? Let me just challenge you. 1 over what? Again, chat there and tell me. I want to see. What is the markup of this company? It must be 1 over what? 1 over 3. Somebody else? You need to know the relationship between markup and margin. 1 over 3. 2 people are giving me 1 over 3. Somebody else? I'm not saying they are wrong. 1 over 3. Somebody else? Okay. 1 over 5. 1 over 5. I'm not saying you are wrong. 1 over 5. So you can see. I hope you are getting my point now. You can see where the tricks the examiner hides. Computing, listen, how to eliminate the unrealized profit is not a big deal. I just told you. whatever is the amount of the unrealized, reduce the profit of the selling, whoever the selling company is, reduce the stock of the purchasing. But you can see the trick was not how to eliminate it. The trick is how to compute the unrealized. Because that's what the examiner would hide. How to compute the unrealized profit. Okay? Now, so listen to this now. Whenever you have a margin, to convert that margin to markup, listen carefully. You take the numerator, let it remain as it is. The numerator normally doesn't change. When you need the markup, listen, you take the numerator and subtract it from the denominator. Take the numerator and subtract it from the denominator. That will give you the markup of that company, which now becomes a third. Listen, sometimes the examiner could give you markup and you don't need it. You need margin. Suppose, listen, I take you back here. Suppose the question told you the company sold goods at 300 at a markup. Listen, if the question had told you you sold goods for 300 at a markup of 25%, then again, you could not take that markup on 300. Because if you sold the goods at 300, 300 therefore became the selling price. So you don't need the markup, you needed the margin, because selling price needs the margin. Cost needs markup. So it is important to know when do I require this markup and when do I require the margin. You need markup if you have cost. You need margin if you have selling price. Okay? Good. Now, going back, we are saying to convert the margin to markup, take the numerator and subtract it from the denominator. That will give you the markup. If the examiner gives you the markup, let's assume to be a third, and for whatever reason, you don't need the markup, you need the margin, then again, take the numerator, let it remain. But now whatever is the numerator, you add it to the denominator. That will convert your markup to your margin. That will give you now your a quarter. So I hope already you can now see the relationship between markup and margin. I have said to convert margin to markup, take the numerator and subtract it from the denominator. That will give you markup. You could simply reason this way. Of course, it's not a good reasoning, but the way to just help you to remember. You can see markup is sales. Markup goes with sales. And normally sales are higher than the cost. So for whatever reason, that's what I'm trying to help you remember. So if the margin is a quarter, and the margin goes with sales, then I know this is more. So I want cost. Let me make it less. So you just minus. If they give you markup, of a quarter, they give you markup of a third, and you don't need it. You know, markup goes with cost. Cost is normally smaller. I need margin. Margin goes with sales. Sales is normally bigger. Let me add. That's a simple way to help you remember. That's not an exact right way, but it is a way to help you remember. Okay? Now, listen. If totally you can't remember that relationship, then you can still prepare your own simple trading account. Just prepare your own simple trading account using your own simple figures. Then compute the markup of the company, compute the margin of the company, see the relationship. For example, let us assume the opening stock of this company was 10. Add purchases 20. That will give you 30. You less closing stock. Let's say 25 or 5. That gives you cost of sales to be 25. Let me assume the sales were 26. This being the cost of sales, my GP will be 1. My GP will be 1. From here, simple illustration, compute your markup, compute your margin, see the relationship. Like if I want the markup, we have agreed, markup is GP, which is 1, divide by what? Cost of sales, which is how much? 25. If I need the margin, we have agreed, margin is GP, 1 in our case, divide by the sales, 26. So already from here, I can see there is a relationship. That if I'm given a margin of 1/126 and I don't need that margin, I need the markup, I just take the numerator, I subtract it from the denominator. That will give me the markup. If I'm given the markup of 1/25 and I don't need it, I need the margin, then I just take the numerator, add it to the denominator. That will give me the margin. Listen, I have said, prepare your own simple trading account using your own figures. Listen, the GP doesn't have to be 1. In other words, the numerator doesn't have to be 1. It can be any figure. Like for example, let our sales now be 30. Our GP will be 5. Doesn't matter. Compute the markup, compute the margin. Our markup would be 5, which is the GP, divide by the cost of sales, which is 25. Now, compute the margin. Margin is GP, which is 5, divide by sales, which is 30. See the relationship. I can see from here that if I'm given margin of 5/30 and I don't need it, I need the markup. I take the numerator, I subtract it. We have agreed. Margin goes with sales. Sales is normally bigger. So I take the numerator, I just subtract from the denominator. That will give me the markup. If I'm given markup of 5/25 and I don't need it, I need the margin. I just take the numerator, keep it as it is. The numerator doesn't change. Take that numerator, I add it to the denominator. That will give me 30. So already I hope you can see the relationship. That when you have the margin and you don't need that margin, you need markup for that particular question. Take the numerator, subtract it from the denominator, that will give you markup. If you have been given markup and you don't need it, you need the margin, take the numerator, add it to the denominator, that will give you the markup, the margin, sorry. Okay? So it doesn't matter whatever you're given. Whether the numerator is 1 or 10, it doesn't matter. Remember, don't change the numerator. It is only the denominator that changes, either increasing or reducing. I hope we have communicated on how to compute the amount called unrealized profit. I've said how to eliminate it is not a big deal. The issue is how to calculate it, where the examiner will challenge you in terms of the amount called markup margin. Markup margin. That's what we are saying. Okay? Good. So let's now put down the summary note concerning that second item. So have another subheading, unrealized profit on closing stock. 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 Then you say this. Say this. Any unrealized profit on closing stock, any unrealized profit on closing stock between group members, any unrealized profit on closing stock between group members should be eliminated. Any unrealized profit on closing stock between group members should be eliminated as follows. Should be eliminated as follows. Debit, P&L, in bracket selling company, credit stock, in bracket purchasing company. Any unrealized profit on closing stock should be eliminated as follows. Debit, P&L of the selling company, credit stock of the purchasing company. Good. Maybe we can put down a small illustration. We can put down a small illustration there just to emphasize that point. Just to emphasize that point. Let's put a small illustration. So andika illustration. Illustration. Sema hivi. H Limited sold goods. H Limited sold goods to S Limited for 400,000. 400,000. H Limited sold goods to S Limited for shillings 400,000 at a markup of 33.33%. At a markup of 33.33%. At a markup of 33.33%. Then you say this. S Limited had not sold half of the goods. S Limited had not sold half of the goods as at the year end. S Limited had not sold half of the goods as at the year end. Then you say this, show the calculation and the recording. Show the calculation and the recording of the unrealized profit. Show the calculation and the recording of the unrealized profit. Show the calculation and the recording of the unrealized profit. Good. Before we do this one, let me take you back to the original one that I gave you the challenge. Before we do this one, now listen. Now you can remember, we were told here, H Limited sold goods costing 300 at a profit margin of 25%. So I told you, you did not need this margin. Let us now work it out. You did not need the margin. Why? Because you are given the cost. So you had to convert our margin, which is 25% was a quarter. You needed the markup, which I have already told you is a third. Then you had to come and say here, profit made. Don't write profit made by H. When H sold the goods, they sold the goods at a markup of a third. These goods costed how much? 300. So H on their own made a profit of how much? A third of 100 is 100. Okay. Therefore, if S has not sold half of the goods, then our unrealized profit would have been a half of 100,000, which comes to be how much? 50,000. So for that one, I expected to see 50,000 in your answer. But most of you who are taking 25% of 300, which gave you something like what? 25% of 300 was about 75. Then some of you are taking half of 75 and they were giving me 37,500. Majority of you, you forgot that the margin should be converted to markup, because you did not need the markup, the margin, sorry. You needed the markup. That was for that one. Now let's go to the second one I have given you. Let's go to the second one that I've given you. This second one, now what do you need? We need to know the profit made by H. You need to know the profit made by H. Now listen, I want to ask you a question. To know the profit made by H, can I take 33.33% of 400? I want the answer as yes or no. Can I now take, to know the profit made by H, can I take 33.33 of 400? I want to see the answer as yes or no. Yes, I want to see the answer. Harakisha kidogo so that we finish. Good. Correct. This time you can see that you don't need to take 33.33. Good. This majority of you can now get the point that I was passing across. This 400 is what? The selling price. Don't write. 400 is the selling price. And therefore, I don't need the selling price. I don't need the markup. I need margin. Good. So for the answer, now let's put down the answer now. Let's put down the answer now. So you come and say here, markup. 33.33 is simply a third. You know that? 33.33 is simply a third. And from this case, you don't need markup. What you need is what? Margin. And therefore, our margin will be a quarter. I've told you to move from markup to margin. Markup goes with cost. margin goes with selling price. I've told you selling price is bigger. So just add the numerator, add it to the denominator. That will give you the markup, the margin, sorry. Good. Then from there, come and say here, profit made by H Limited. It is a quarter of 400. Those are the goods. They sold the goods for 400. Now that you have the margin, you have the selling price, the two go together. Now you can take the two. That gives you a profit of how much? 100. Then you come and now say unrealized profit, where you now go and ask yourself, what proportion of the goods, what proportion of the goods have not been sold? We are told half of the goods have not been sold. So you take a half of 100,000, which comes to be how much? 50,000. Good. Now you have the unrealized profit of 50. Then you eliminate it. I've said you debit P&L account. Who is the selling? H Limited. 50,000. You credit stock. Either you credit group stocks or just stock of S, no problem. 50,000. Good. So you are reducing the stock of the purchasing company and you are reducing the profit of the purchasing, of the selling company. Good. Okay, we have no time to move to the next item. We have no time to move to the next item. We have no time to move to the next item. But I hope now you're okay with the two so far. We have dealt with one called intercompany debt. We have dealt with the second one called an unrealized profit. This unrealized profit, one must be very, very careful because of those complications that come in when you're given markup, margin, selling price, cost, blah, 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 whatever it is. One must be very careful. Good. So maybe we can stop there. We continue from there. Remember, I told you, listen, I told you that I'm combining both early morning and the evening group so that we finish this topic with the remaining time. So that it's like we are adding 3 lessons per week. For the normal ones you normally have, if you are a normal early morning student, now you'll be joining us in the evening also, for the evening students also. For you evening students who have joined us today, this is early morning. You know, we have said again, during your time, the early morning will be joining you so that we finish the syllabus or this topic in good time. So with the remaining time, okay? So maybe we can stop there. We meet today evening, where now we go through the remaining key issues that I told you you need to remember concerning group balance sheet. We have said there are several things you need to remember concerning group balance sheet, and they are also tested at this level. We have said you need to know how to deal with intercompany debt, which I've talked about, that it should be eliminated. How to eliminate it, we have discussed. When the amount is not the same between debtors and creditors, either cash in transit or goods in transit. Now we have dealt with the second one called unrealized profit, how it also should be eliminated. So today evening, I go to the third one and the other remaining items. That is debentures in subsidiary. That's what we are going to start with in the evening. So let's meet in the evening, where we now start with what we are calling debentures in subsidiary. Have a good day. See you in the evening. Have a good day. Bye for now. Bye for now. See you. Bye. Okay. Good day. Okay. Okay. Bye to you.